Good morning, my dear friends. Last time when I was talking to you, I made a summary of the macroeconomics. This time, I thought about why not give one of the most important chapters in macroeconomics, national income, the concepts used in national income, and the methodology followed in national income. Okay, so let me start. It's COVID-19 shutdown time across India. So this service I'm doing for all the students from MPA to BA Economics to BCom students, for BTech students across for all the streams, because this is a chapter very common in all the syllabus. Let us study what national income and the importance of national income and the methodology of national income. Let us see first. What national income all about? National income is the aggregate money value of all final goods and services produced within the domestic territory in a financial year. This is the definition of national income. Now let us decode it. Okay, let us decode this definition. What does it mean? It's the aggregate. As we use it as aggregate, the first characteristics of national income is that it is macroeconomics. It's a study of macroeconomics, because we are here studying about the summation of all the incomes generated in the whole nation. So here we talk about macroeconomics. Second, money. Why we take money values? Because different goods are produced in different physical quantity, and therefore you cannot add them physically. So what we do, we need a common measurement. Money is the common measurement. So the second character of national income is money. The third character is of all final goods and services. So in national income accounting, we take only final. Remember, we take only final goods and services, no reference to intermediate goods. We will not consider intermediate goods. The reason is that if you consider intermediate goods and final goods, it will cause double counting or triple counting. To avoid the problem of double counting, we consider only the final goods. We will not consider the intermediate goods. Then, produced within the domestic territory. Why domestic territory? $1 billion question. The national income is accounting is done for the domestic territory. What's the reason? What's the logic behind it? The logic is that I want to know, as the national income is generated, how much employment it is generated. So there is a direct relationship between the output produced and the employment generated. You cannot produce the output without putting the labor into employment. And therefore, in a nation like India, we are more interested in a growth with job rather than jobless growth. And therefore, how much employment is generated is more important when you study national income. And finally, the fifth character is that in a financial year, national income is done for a given period of time, quarterly, half-yearly and yearly. But normally in a given period, what we call it is a financial year, that is 1st April to 31st March. So let us recap very quickly what national income all about. National income is the aggregate money value of all final goods and services produced within the domestic territory in a financial year. Now let us decode it further. What are the concepts used in the national income? What are the important concepts we use in the national income? The 4 important concepts we use in the national income. The first is GDP. The second is NDP. The third is GNP. And the last one is NNP. Let us see one by one. Okay. GDP means gross domestic product. NDP means net domestic product. GNP means gross national product, and NNP means net national product. It is the GDP is the motherly figure, the original. This is what we get when we get initially the gross value added by adding the value of all the final goods and services produced. So the definition of national income is the definition of GDP. So GDP is the aggregate money value of all the goods and services produced within the domestic territory in a financial year. Now, in the making of these goods, some sort of depreciation is there. This depreciation has to be deducted if you want to know the net domestic product. So, what net domestic product is equal to? NDP is equal to GDP minus the capital consumption expenditure, or what we call it popularly depreciation. We can also call depreciation as a capital consumption expenditure because it is what consumes the fixed assets, and therefore that has to be deducted. So what is the difference between GDP and NDP? Is nothing but depreciation. Now let's take the case of GNP, gross national product. You have to add what is received from the foreign nationals. That is the difference between the foreign nationals receiving in India and the Indians receiving in the foreign countries. That is what is called NFIA. So when the GDP is adjusted to NFIA, NFIA means net factor income from abroad. Okay, it can be either plus or minus. It is plus if our people are earning more than foreigners in India. It is minus if foreigners in India earns more than other people, that is our own people, that is the NRIs. And therefore take the difference. It can be either plus or minus. If it is plus, it increases GDP. If it is minus, it decreases the GDP. Then we come to the NNP, the final one. What do? We take from the GNP. So it has two ways we can take it. Either you can take it from GNP. In that case, in this depreciation is included, so we minus the depreciation. Or other way of doing it is that take it from NDP plus or minus NFIA. So when you do plus or minus NFIA, you got it, the net national, and that is the final measure of national income. So the final measure of national income is net national product. Now each measure we can further divide into two. So GDP we can divide into two: GDP at market price and GDP at factor cost. Similarly, NDP at market price and NDP at factor cost. Similarly, GNP at market price and GNP at factor cost. And finally, NNP at market price and NNP at factor cost. Okay, exactly market price. Market price is what? The original one. That is the calculation of GDP at the existing or prevailing market price. And when you deduct two things, that is, there is a two adjustment, that is minus, that is GDP market price minus indirect tax, that is GST now, plus subsidy. Okay, that is why. Okay, we have now slightly changed the methodology in India's measurement of GDP. Earlier we calculated at factor cost. Now, in 2015, Government of India has changed the methodology. Now GDP is measured at market price. So if you want to go from factor cost to market price, what you do is just opposite. GDP factor cost plus indirect tax minus subsidy. What here we did, minus indirect tax plus subsidy, just to the opposite, reverse, you will get the GDP market price. And remember, under new methodology, we study GDP at market price, not at factor cost. The second major changes which has been done by the current government is change in the financial year, in the base year. Earlier, the base year was 2004-05. Now the base year is 2011-12. So there are two changes. One, the base year is changed from 2004-05 to 2011-12. And second, the methodology that is calculating GDP at factor cost is gone. Now GDP is calculated at market price. Let us study both factor cost as well as market price. Same formula everywhere. So if I want to know what is NDP market price, we know what is NDP. NDP is equal to GDP minus depreciation. and therefore NDP market price is equal to GDP market price minus depreciation. Once I get NDP market price, then NDP factor cost is equal to NDP market price minus indirect tax, that is GST plus subsidy. Same is applied when we talk about GNP market price as well as GNP factor cost. So GNP market price is equal to, GNP comes from where? We already studied here. GNP comes from GDP. So GDP market price, what we did, plus or minus NITIE, and that is exactly what is called GNP market price. So exactly what is GNP factor cost? GNP factor cost will be equal to GNP market price minus indirect tax, that is GST plus subsidy. Now we come to NNP. What is the formula for NNP? GNP minus depreciation or NDP plus NITIE, and therefore for NNP market price we have two formula. One is, you can either take it from GNP minus depreciation, so GNP market price minus depreciation, or you can take it from NDP market price, that is NDP market price plus or minus NFIA. Okay, once you get the market price, the factor cost is very simple. The factor cost is what? We adjust NNP market price minus indirect tax, that is GST, now the new name, plus subsidy. Thus, in total there are 12 concepts. The four major concepts is GDP, NDP, GNP, NNP. GDP is the original one. Okay, there is no formula. Of course, hypothetically you can give a formula. What is that? GDP is equal to NDP plus depreciation. But then that formula doesn't looks logic, because you will never get NDP without GDP. This is only a hypothetical formula. So NDP is equal to GDP minus depreciation. And then we got to GNP. It is national. So what difference between GDP and GNP is the NFIA, that is net factor income from abroad. Right? Then finally from GNP, if you adjust the depreciation, you deduct the depreciation, or from NDP you adjust the NFIA, you get what? The NNP. And from here we further divide each measure into factor cost and market price. Market price means the prevailing existing market price. Factor cost means you deduct from the market price the indirect tax and you add the subsidy. That is what you do in GDP, in NDP, in GNP and NNP. So any one you do it, that's, you don't need to do repeatedly. You have to do either at GDP level or at NDP level or at GNP level or at NNP level. Now we go to study the computation of national income. Let us study the computation of national income. How does the national income is computed? The national income is computed based upon three major methodology. The three major methods are either product method or what is popularly called the income method or the expenditures method. So naturally there are three methods are there. And these three methods are: one, the product method. Second one is popularly called income method. And the third one is popularly called the expenditure method. These are the three methods used in national income. Let us study very quickly what is product method. Under product method, national income is calculated by adding the outputs by three different sectors. Indian economy is divided into primary sector, secondary sector, service sector. Then primary sector, agriculture and related, secondary sector, industry and related, and service sector, all the services, banking, insurance, shipping, all will be added, trade, all will be added, you get what is called. So you divide the economy into three sectors, and the first one is called primary sector, the second one is called secondary sector, the third one is called tertiary sector, or what we call it, the service sector. Primary sector means agriculture and allied sectors, fishing, mining, all comes in primary sector. You take the value. Remember, one of the important precaution in the product method is that you should take only the value of the final output. You should not take the intermediate goods, otherwise it will cause double counting. And therefore we take only the final output value. Secondary sector added by the secondary sector, manufacturing, etc. Third, tertiary sector, the banking, the insurance, the shipping, the trade, the communications, all comes under the tertiary sector. Add them, adding together, you get the GDP. So what do you get by adding the three sector final output? Remember, minus intermediate goods. We will not consider the intermediate goods. We take only the final output. What you get is the GDP market price. Minus depreciation, you get the NDP market price. Okay. Right. Once you get the NDP market price, you can adjust here. That is minus indirect tax plus subsidy. So what you get is that NDP factor cost. Once you get the NDP factor cost, from there you do what? You adjust the NFIA plus or minus NFIA, you get what? The national income. That is called NNPFC. Remember, finally we have to come to NNPFC, and now in the new system it is NNP market price. So what you do? Minus indirect tax, you do here plus. Okay, then plus subsidy, you do here minus. That's it. So if you do the reverse one, you will get back from factor cost to market price. Now what we do it here? So exactly, if you want to know important two precautions in product method is, number one, only final goods will come. That is, intermediate goods will not be considered. Number two is that second-hand goods sold, purchased will not be considered, because they have already been considered in the year it were making. And again, those which were made for self-consumption, they can be considered, because if it not self-consumed, it is available for the market. However, the service rendered by the housewife will not be considered in the product method. So in the product method, the precaution you have to take is that only the final, the intermediate goods will not be considered. Secondly, in the product method, you are very careful is that the goods used, some farmers, they produce the farms and they themselves consume. Yes, that will be calculated. Why? Had they not taken it for self-consumption, that could have been available for the market, and therefore those have to be added. But the second-hand goods sold or purchased will not be considered for the national income. Now we come to the income method. As the name suggests, the distributive method or the income method, what we do, we add all the income, that is the wages, the rent, the interest, the profit. So the first is the compensation to employees. In compensation to employees, that is what we call it wages, but there are other categories. Example, for example, one, wages can be paid in cash or sometimes in kind. Sometimes big executives are paid rent-free accommodation. So that rent-free accommodation is an example of wages paid in kind. The third one is social security payment. The social security payment is, for example, the deduction of provident funds. All these three will come under the category of wages. The second category is rent. The third category is interest. and the fourth one is called profit. Adding these three together, it is also called in economics operating surplus. But remember, in profit there are three components. Component 1, the corporate tax. Component 2, dividend paid out of profit. And component 3, the undistributed profit. These three will come under the category profit. Now, adding these three along with some mixed income. What is mixed income? Just now we talked about. That means some farmers or some producers, economic agents, produce certain things which you don't give it to the market. They do it for self-consumption. Some small business that can be added into what? The mixed income. When you do all, you get NDP. Remember, NDP factor cost. The question of GST doesn't arise here. This is income method. No taxation, nothing. No depreciation here. It's the income method, no depreciation. So what actually will come? The adjustment of NFIA. So plus or minus NFIA, you get what? The NNPFC, the final one. The NNPFC. Right. So that's clear, the income method. You take the addition of all the factor income, the wages, the rent, the interest, the profit. Now we come to the expenditure method. In expenditure method, we use a popular formula. National income is equal to C plus G plus I plus delta S plus X minus M. Now what is C? C is equal to private consumption expenditure. So you have private consumption expenditure. You have, some figures will come. You have government consumption expenditure. Of course, government also spend money for furnitures, for the stationery, etc. Investment expenditure. The investment expenditure will also come. Okay, again it is private investment, public investment. And delta S means the closing stock minus opening stock, stock consumed. That will also come. We can also call inventory investment. This is inventory investment. And then finally, the X minus M is nothing but the net export. That means export minus import. Export minus import. Exports minus import. Remember, it can be either plus or minus. If export is greater than import, it is plus. If import is greater than export, it is minus. So it can be either plus or minus. Adding together, what you get is what is called GDP market price minus depreciation. You get NDP, you get NDP here. That is market price, remember. Market price to market price. But remember, from market price to factor cost minus indirect tax plus subsidy. Then you get NDP factor cost. What you get is called NDP factor cost. Remember, plus or minus NFIA, you get the final one, NNPFC. But remember, this is what we do earlier. But remember now, we don't need to come to NNPFC, we need to come to NNP market price. Because under new methodology, the GDP is not calculated at factor cost, but it is calculated at market price. Two changes done is changes in the base year and changes in the final measure. That earlier the final measure was factor cost, now the final measure is the market price. These are the two changes. But again, one important thing you have to study is always, whenever we talk about GDP, one is called GDP current price, GDP at current price, and another is called GDP at, say, market price. This one is called GDP at current price, that is the real GDP. Yeah. And this is GDP, for example, just slightly, the GDP we divide into the real GDP and the nominal GDP. The nominal GDP is the GDP at the current price. This is the market price. Okay, this is the base year. So the GDP at when we consider the base year, say when we right now we are in 2019-20. So 2019-20 GDP we measure at the price of base year. So right now the base year is what? The base year I said in my lecture, the base year is 2011-12. So if you measure 2019-20 GDP at the price of 11-12, it is called real GDP. And if you measure at the current price, it is called current GDP or nominal GDP. Right? So the difference is what? The difference is nothing but inflation. So that is what in economics we call it GDP deflector. So what is GDP deflector? The GDP deflector is equal to the nominal GDP. The nominal GDP divided by, so nominal GDP divided by real GDP multiplied by 100. This is called GDP deflector, and GDP deflector is nothing but the inflation, the price level. It is what the changes in the price. I said what is more important? More important is real GDP. A real GDP tells us the improvement in the quality of life. But nominal GDP doesn't speak about that. And that is why when the finance minister kept 10% in the latest budget, that 10% is nominal GDP, not real GDP. Economists are more interested in real GDP because real GDP measures the improvement in the quality of life. Finally, if I don't predict what will happen because of the shutdown in the GDP of the country, it is unfair. So what will happen for different countries, the things will be different. In developed countries like US, Italy and all, the effect is fatal. So in a country like USA, Italy, UK, Germany, these are the countries we predict this type of GDP. That is GDP time. After COVID-19, say this year is a bad year for all over the world, but doesn't going to impact adversely uniformly. Remember, different countries will have, developed countries will have a L shape. The reason is that they are at the receiving end, whether it's Italy, whether it's Germany, whether it's USA, they are at the receiving end. So they will not have a quick recovery. In a country like China or India, we expect a GDP over a time period, a V shape. We will have a V shape, means of course the GDP is falling, but India and China both are consumption driving economy because of huge population, and therefore we will have a quick recovery that is V shape. In other countries like Iran, Iraq and all, if we explore further the COVID-19, then they may experience a U shape. U shape means a longer bottom. Okay, a longer bottom. Right. This is what Middle East countries and others may face because it is export driven economy. Their economy is based upon one or two export, particularly the petrol, which is called the black dollar. So if the COVID-19 continues and explode in Middle East, they will experience a U shape. That is, U shape means they have to reach out the bottom and stay there for a longer period of time. Recovery will take more time, but recovery will be faster in a country like India and China. And in the long run, it's India which is going to be the superpower. The reason is that even when we compare to China, we have a huge young population, and therefore the production and productivity will be at much more higher level. And particularly other countries are finding fault with China for the COVID-19. The world is going to research China. So the next best investment destination is of course India. And therefore, once we quickly recover from COVID-19 aftermath, after the economic disaster, which is very short-lived, India will go for a very, very quick recovery. And not only that, we will lay a strong foundation for a strong nation. With all the foreign investments coming to India, India will become the most attractive destination of global FDI. And remember, once India is empowered, no power can stop India. She will be simply unstoppable. Thank you. All the best.